Hey guys, this is Money Value. My name is Olga and Happy New Year! I hope 2021 started with a good note for you. So, what happens to people during economic recession or when inflation hits? They start actively looking for the ways to make money. The tricky part is, in that case, the best solution would be the opposite of active. Yep, you got it right. I'm talking about passive income. First of all, I hope you all know what inflation is, but just in case, it's when your money gets cheaper. I'll give you an example. $1 in 1919 is $15 nowadays, so if your favorite avocado toast is $15, you could have had 15 of those 100 years ago. By the way, one more difference between cryptocurrency, for example Bitcoin, and fiat money: Bitcoin emission is limited, so it cannot fall in value due to inflation. That means its value, especially in comparison to fiat money, would only grow during time. The last one, however, is really unpredictable. One tiny little change in the world and dollar's value goes crazy, whatever it means. Have you ever wondered what the best stocks are that will pay you money to hold them? Those are called dividends. Companies that make so much money they reward their shareholders for investing in them. Some of these companies have even paid their shareholders for 50 years, surviving the toughest economic recessions and technological advancements. Today, I want to show you the 7 stocks that have paid their dividends, and most of them even increase their pay every single year. These are some of the best stocks to own. Mind you, it's your decision whether to buy them or not. I'm not making you do anything, just sharing something I know. Here we go. The first one is the 3M Company. It's an American multinational conglomerate corporation operating in the fields of industry, worker safety, US healthcare, and consumer goods. Why choose this one? Obviously not because they are saving the world or something. The reason is its yield is 3 to 4%. It's like really good. It means every $100 would bring you $3 to $4 every year. Besides, there is the thing called dividend safety scores. It helps investors see if the company can be trusted or not. As long as it's 60 to 100, you're good. It means the company will keep paying dividends even during a recession. I mean, no one makes companies pay their dividends, it's always their own decision. And if they decide to keep those payouts up even when things are bad, it only means that investors have a reason to keep the shares they owe. It makes them more loyal. Back to the dividend safety scale. 30 to 60 means dividends might be kinda cut during the recession. 0 to 30 means, well, it means you shouldn't buy the stocks unless you want to be screwed. Okay, second one, AT&T. I'll lead with this. They declared a quarterly dividend of 52 cents a share, or the $2.08 per share annual dividend, now yields approximately 7%. That's huge! AT&T is dividend aristocrat due to the payout hikes that have occurred every year since 1985. I'm really impressed with this one. I don't want it to go unnoticed, so here is some more info. In 1994, AT&T was one of the top 15 companies of Fortune 500, and now they're partners with Amazon. But let's talk today, not yesterday. Coronavirus hurt people, but it also hurts businesses. One of the restrictions was closing the movie theaters, and after they were allowed to work again, people were simply afraid of going in there. And we can blame them. Safety first, right? In spite of that, in July, CEO John Stankey said that he is willing to increase the payout ratio from 50% to 60% to sustain or raise the dividend. The company expects to have the financial flexibility in 2021 to continue to invest in growth areas, sustain the dividend at current levels, and focus on debt reduction. Sounds like a good plan to me. Next one would be one of the world's largest publicly traded international oil and gas companies, ExxonMobil. Its dividend yield is 8.37% and the annual dividend is $3.48. A few months ago, this company was called, and I quote, a cash machine that has no need to cut its dividend. And I guess there is no need to worry. The payouts has been a bigger priority for an oil giant than any of its projects. Well, this pandemic situation broke the 18-year streak of raising the payouts, but ExxonMobil didn't cut it either, so it's good news. Now you might want to stop to say, wait a second, isn't it like an oil company in the age of Tesla and NIO producing electromobiles? That's true, if oil is unpopular in public markets, then exit them. But there is still massive demand for petroleum, increasing demand for natural gas, and Exxon's chemical business produces the polyethylene and polypropylene that makes electric cars much lighter and more efficient. So I guess it's a win-win. Here is number 4 for you. Johnson & Johnson. It's an American multinational corporation founded in 1886 that develops medical devices, pharmaceutical, and consumer packaged goods. Its common stock is a component of Dow Jones Industrial Average. We're looking for a stable passive income, right? Well, they have 2.9% of dividend yield. It's good, and the best part is, it's stable. By the way, it has grown by 6% during the last 5 years, and the stocks went up 38%. We have lived through 2020. That made us really appreciate our health. That's why I can't forget to mention AbbVie, an American publicly traded biopharmaceutical company that was founded in 2013. They declared a quarterly cash dividend of $1.18 per share, and the dividend yield is 4.9%. Since the company inception in 2013, AbbVie has increased its dividend by 195%. Oh, and here's a pic showing their dividend history if you're interested. Let's talk about their 2020 performance. In the third quarter, AbbVie's revenue of $12.9 billion increased 52% year over year. They earned $2.83 per share during the third quarter, up 21% from the previous year's quarter. You don't have to be an expert to know if those numbers are growing, it's good. Isn't it wonderful that something that saves lives can also bring you money? Maybe this world is not that awful after all. Next one is an American commercial real estate company, one of the largest retail real estate investment trusts, and the largest shopping mall operator in the US. Please welcome Simon Property Group. They pay an annual dividend of $5.20 per share with a dividend yield of 6.10%. The COVID-19 lockdown has hammered the retail business, and earlier last year, Simon Property cut its distribution by more than a third in order to conserve cash. Dividend yield has also decreased from almost 8%. One more scale for you. There is something called the payout ratio. A range of 35% to 55% is considered healthy and appropriate from a dividend investor's point of view. A company that is likely to distribute roughly half of its earnings as dividends means that the company is well established and the leader in its industry. Well, SPG based on the 2020 estimates has 54.22%. Oh, and the last thing, the company's strong balance sheet. In summer, Simon Property had only $1.40 in debt for every dollar of equity. Now, compare that to competitors, they have more than double that amount. It means that SPG pays far less in interest than its peers. That leaves management with a lot more flexibility than its peers to navigate the current economic crisis. Check this graph out. We've got to the last one. I want to tell you its story, pretty sure you're well aware what Coca-Cola is about. We have always drunk it and we always will. They say taste the feeling. You could very well do that, but what about tasting more than 3% of dividend yield and 80 scores on the safety scale? Anyway, those were 7 companies that could boost your passive income. I hope you'll find what you are looking for, but I gotta warn you, there is a good chance you'll make some mistakes first. Don't be afraid of that. I'm sure you'll do great. Stay tuned and I'll be back with even more great info. Thank you for watching this video till the end. Please don't forget to press the like button and subscribe to this channel for more finance related videos. Thanks, see you soon!